Is the stock market expensive? Is it overvalued? I've got a few charts that show us the answer. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Is the market cheap? Is the market expensive? Is it right there in the middle, Goldilocks? If only we knew perfectly, right? And we could anticipate where the market was going, then we could make adjustments. The problem is there's no perfect indicator. There's no perfect way of saying the market's cheap and therefore there's, the sky's the limit, or the market's expensive, better watch out, things are going to drop here in a short period of time. There's no perfect way. However, Warren Buffett has said this is, he has his Buffett Indicator, and he didn't call it that, but he said this is the single greatest measure of whether the stock market is overvalued, undervalued. And we're going to go through that here in just a second. Plus, there's my favorite way of assessing whether the market is cheap or expensive. Let's tune into those figures, okay? And then we can draw some conclusions off of it. Reason why this is interesting to look at right now is markets always follow earnings. They always follow earnings, and sometimes markets get ahead of themselves and then the earnings really don't follow. And then sometimes the market is more pessimistic and then earnings start rebounding. And so if you take a look at last year was a fantastic year in the stock market, surprised just about everyone. Most of, or almost all of the returns came in in the last couple of months. And you can see here based on this chart, I know there's a lot of data here, but the actual earnings, so the actual profits of the companies expanded about 8% last year. And so you'd expect if the stock market and earnings are connected, then the stock market should have grown 8% last year, but it didn't. It grew at significantly more than that. So there was a 14% expansion in the multiples. Basically, stocks got 14% more expensive last year simply because earnings went up 8%. The S&P 500 went up well over 20%. And you can look here at 2022, it was the opposite. Earnings, or that expensiveness contracted, so the markets got a little bit cheaper. They were a little bit cheaper the year before as well. You can see that contraction or expansion based on what's going on with the multiples. So it's a good time, especially as we've seen such incredible performance in November, December, and even January. Is the market now expensive? We need to brace ourselves for things to for things to come back down, or is the market fair valued or even cheap? And listen, sky's the limit. Well, let's first look at the Buffett Indicator. And again, he didn't come up with this, but he said that take the entire total market cap divided by GDP. And he said that is probably the best single measure of where valuations stand at any given moment. So total market cap divided by GDP. And that is, you can't argue with that. How big is the stock market compared to the actual economic activity from those stocks? Now, the tricky thing is that's GDP nationally, and a lot of these organizations have they're global. It's a global world, obviously, and so you gotta probably qualify this a little bit. But compared to history, this Buffett Indicator is suggesting that stocks are significantly overvalued. And in fact, if you dive into the data, that if you could extrapolate an expectation off of this, that the expectation would just be that stocks should earn 1% a year moving forward, and that includes a dividend yield of about 1% a year. And so based on the Buffett Indicator, or based on this valuation, stocks are overvalued. You shouldn't expect a lot of appreciation from stocks moving forward. Now that's Buffett's favorite measure, my favorite measure, and most financial planners and economists price to earnings, the PE ratio. In fact, I like the forward-looking PE ratio. So essentially the price, what's the price you're paying for that stock, or in this case, the S&P 500, compared to the earnings, the profits of the underlying companies. And oftentimes, and it's the most accurate PE, is the one looking backwards. Okay, so what's the price today compared to the earnings that these companies just reported and had? The issue is the price is forward-looking, okay? Earnings is what happened in the past. So therefore, this forward earnings is based on companies' projections, if they give any guidance on here's what we're expecting our earnings to be. Fewer and fewer companies are giving guidance, so more of this, these forward earnings are projected or anticipated or just sort of extrapolated forward. So it's not a perfectly accurate number, but how could it be? It's a forecast of the future. So current price compared to expected future earnings. Take a look here at this sheet. It's from JP Morgan. It's my best illustration that I found on this, and it shows the 25, 30. What's that? 30-year average. That street right there in the middle, and right in the middle, that dotted line shows the 30-year average of 16.59 times. Okay, 16.5 multiple. So essentially, if you were to if you had a really big checkbook and you wanted to go out and buy the stock market, a fair price would be 16 times earnings. Said differently, and for those of you that haven't made this connection, said differently, you buy the S&P 500, hold it for 16 years, and you'll eventually get all your money back. And so that's the multiple, okay? That lower band of 13.3, that's one standard deviation or one average measure, okay? That's my oversimplification. One average measure lower. So you would say at that level or below, stocks are cheap. The street line above that one standard deviation, the plus one standard deviation of 19.83, that's where you'd say, well, stocks are expensive. Stocks could be overvalued there. And obviously we saw that during the tech bubble. They call it a bubble for a reason. We saw that right after COVID in the $5 trillion of money spent. And if you're a follower of the Wise Money Show, we were warning there and said, no idea what this means for stocks exactly when, but stocks are expensive. And you can see where we're at right now. We are approaching that upper band. And so therefore you would say, yeah, stocks are fairly expensive. Okay, so I think the data is suggesting that stocks are expensive today compared to kind of historical measures of both GDP and profits. Therefore, we need profits to grow significantly. We need GDP activity to continue to grow and stocks to not grow quite as much, and then things can maybe even out and balance out. But if right now, both of these indicators, very strong indicators, are suggesting, hey, stocks are expensive, then should we brace ourselves and expect that the market's going to go down? No, because you need to look at the very next chart by JP Morgan, and that is the correlation, geek speak, that is the connection between that forward price to earnings and then what actually happens with the stock market. Here on the left, that shows where was the forward PE, and then what was the 1 year return 1 year later? What did stocks do over the next year? It's completely random. It is completely random. So even though a bunch of smart people can look and say, see, stocks are overvalued, they are expensive right now, it has no correlation to what the stock market does in the short term. Absolutely none. None. It's a leaf in a hurricane, guys. You cannot predict where the stock market's going. You cannot reliably do it. Can you do it? Again, I've shared this quote recently. One of the most dangerous things in investing is to be right 1 time in a row, because likely that right was just a hunch and you guessed right, because it's just there's no connection. So we could say markets, it looks to be expensive, and that really, I would not take action on that because there's no correlation. Even if you look to the chart on the right here, this shows, well, what do stocks do on average over 5 years? We start to see a pattern, okay? But that R squared, sorry, really geeky, that is still no correlation, essentially. You'd want to, in order to be correlated, you'd say, well, that R squared needs to be above 50, maybe, even higher than that. And it's not. At 30, it's just still not correlated. You can start to see a pattern, but not very clearly. Therefore, when valuations are high, or when the price compared to earnings, or when the price of the overall market compared to GDP is high, yeah, that does influence returns and how much they can go in the future, how much higher they can go in the future. But it's not going to make an immediate impact, nor is it something that you should take action on because, things are going to change. I need to brace myself. So today, I would set your expectations that, yeah, we could see some turbulence. What we need is the economy to really grow, and we need companies to report stronger earnings. And as they do, the stock market might not go up as much as they report those strong earnings or as we see the economy grow. Brace yourself for some volatility because, hey, stocks appear to be overvalued, but stay the course. I wouldn't make any change in direction or your overall strategy simply because all the data and history suggests it's just not correlated. So stocks are expensive right now. That doesn't necessarily change or need to change your approach. In fact, I would tell you it shouldn't. Work with your certified financial planner. Make sure your investment decisions are connected to all 6 areas of your financial life and that you've got sound and prudent investment strategies, long-term investment strategies to help you get from where you are to where you want to be, reaching your financial goals. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.